Well, I have a treat for you guys here today. Today I'm going to go in depth on exactly how Warren Buffett invests his money, into detail, exactly what he looks for in an investment, and how this guy just makes more and more money all the time. We're going to go super in depth into this today. If you don't already know, Warren Buffett is one of the most successful investors ever in the history of the world, okay? I would say arguably the most successful stock market investor ever, okay? This guy's worth somewhere around $80 billion right now, and this is after he's already given away an inflation-adjusted amount of around $50 billion in his lifetime. Think about that for a second. This guy's given away around $50 billion already, and he's still worth $80 billion. That's like ridiculous to even think about, guys. So I'm gonna go super in depth into this video today. We're gonna look at everything that exactly how he picks an investment, what he does, what he doesn't do, what he doesn't get involved with and whatnot. Hope you guys really enjoy this. By the way, make sure you follow me on Instagram if you're not already. I post a ton of content on Instagram, especially on my Instagram stories. So look forward to having you guys on there. All right, so let's start this off with what Warren Buffett doesn't really invest in, okay? Warren Buffett, despite his many billions of dollars, he doesn't really invest in real estate, okay? Which is, when you think of billionaires, you think real estate. You think, oh man, billionaire. He's got to own 5, 10, 15 properties, mansions all over the world, different countries. Maybe they even own apartment complexes or condo complexes or things like that, and they get, bankrolls coming in from that. Warren Buffett, despite being worth billions of dollars, virtually owns no real estate. The only thing he really is involved with real estate is his company Berkshire Hathaway has a home services side of their business, which helps sell homes. And he also owns Clayton Homes, which actually builds homes, okay? Other than those two things, he's almost kind of like not even in real estate. It's unbelievable how little real estate this guy owns. He owns a home in Omaha, Nebraska, which isn't even a mansion. It's like a decent home, right? He used to own a home out in California. It was a nice beach home, but he actually put that up for sale about a year ago or so. So he probably doesn't even own that property now. He owns a few farms, but it's very, very little property this guy actually owns. It's almost incredible, okay? It's almost incredible how little this gentleman owns, okay? He doesn't really invest his money in commodities, okay? He doesn't invest his money in crypto or anything like that, or let's just say alternative investments, all right? This guy, what he invests his money in, what he wants is he wants income producing assets, okay? Income producing assets. What is an income producing asset? An income producing asset is anything that throws off money all the time, which is businesses, okay? Businesses, what ends up happening, you own a profitable business, that business brings in money, okay? They bring in money pretty much consistently every single day. And that money can get thrown off to his company, which he owns a huge ownership stake in, okay, which is called Berkshire Hathaway, okay, Berkshire Hathaway. So he owns all these businesses. Some businesses he owns 100% outright, okay? He owns 100% of that business, and others, he owns a percent of that business, okay? Which is through stocks, all right? He will buy stocks of ownership in a business, which when you buy a share of stock in a public company, you are becoming part owner of that company, okay? Depending on how much you buy for is how much you own of that company, all right? So that's what he's doing. He's buying ownership stake. And usually when he buys stocks, he buys an ownership stake generally in companies of between 5% and 10% of that company, all right? He usually likes to keep it under 10%, I've noticed, all right? But generally it's between 5% of that company he owns and 10%, all right? So that the companies that he owns 100% on, they make all these profits, all right? And he takes that money and it goes to Berkshire Hathaway, and then he goes and invests that in more businesses, all right? It's a beautiful thing, right? These stocks, many of them are dividend payers, okay? Many of them pay dividends, and these dividends get paid out to his Berkshire Hathaway. His Berkshire Hathaway then buys more businesses or goes and buys more stocks. And his amounts of dividends he gets, the amount of profits he gets from the business he owns 100% of, it just goes up and it goes up and it goes up and it goes up, and the profits just get bigger and bigger, and his net worth just goes up. Even despite, how much money he's given away, his net worth still continues to go up and up and up. It's a beautiful, beautiful, beautiful thing, right? But how does he manage to make money so many more times than he loses money in stocks, right? right? The amount of times Warren Buffett has lost money in stocks is like this much, you know, is a very few times that I can look at and I'd be like, Warren Buffett actually lost money. Because sometimes he'll buy a position, and even if that position went south, he probably made more in the dividends than what he lost on what those shares went down or didn't do over that amount of time. The amount of times Warren Buffett makes money, it's like ridiculous, guys. It's ridiculous. So we're going to talk about exactly what Warren Buffett looks for in a stock and how he kind of thinks about building out his portfolio and whatnot. That's what we'll get into next. But once again, all these other, ways of investing, it's just not something that interests him. He wants to own businesses. Part of businesses or the whole dang thing, okay? Either one works for him. He wants those businesses to throw off profits to him, their income producing assets. He makes that money, he invests it into more, and that is his strategy, and that's how he's built an unbelievable amount of money. He's just done that over time and time again, okay? So, stocks. How does he think about, investing in stocks? What is he actually looking for when investing in stocks, all right? Well, first let's talk about what he's not looking for, okay? He's not looking for a company that is highly risky, okay? Let's put over here the not category. He doesn't want a company that is risky. He does not want a company that's risky. If this company doesn't have much competitive moat or they're in a risky field, he feels he doesn't want that, okay? If it's not in his circle of competence, his CC as we'll call it, which is circle of competence, basically what that means is it's your fundamental understanding of what that company does or whatever you're investing in, what it actually means and what it does and how that can make you money and whatnot. That's your circle of competence. I think this is a phenomenal thing. No one should ever invest in anything. I don't care if it's real estate, stocks, commodities, crypto, I don't care what we're talking about. You should never ever invest in something if it's not in your circle of competence. You don't fully understand everything about that company or about that piece of real estate or that crypto or whatever it is, that commodity, man, you shouldn't be investing in it. It's got to be in your circle of competence, okay? He also doesn't like anything that's got a bad balance sheet, okay? A balance sheet meaning, what that company has in assets versus liabilities. Of Warren Buffett's very, very few mistakes I've seen him make over his investing career, I don't ever remember him investing in a company that went bankrupt. And if he did, it was a long, long time ago, okay? Not in like modern history. I don't ever remember him investing in a company and it went bankrupt, okay? Because they had a very poor balance sheet. All Warren Buffett companies generally have very strong balance sheets. They generally have a ton of cash or investments on their balance sheet. They generally have very low debt, or if they do have debt, it's manageable. And the company is super profitable. He's not gonna buy companies that there's no profits, okay? If there's no profits coming in, he's not buying it, okay? He's not buying companies that are non-profitable. So many people buy these companies and they don't make any profit. That makes it a big risk, man. You buy a company that they're not making any money on that bottom line, you're taking a big risk there. He doesn't mess with that, man. So that's what he's not looking for, okay? If it's risky, if it's not in his circle of competence, if it has a bad balance sheet, if it doesn't make profit, he's not looking for those type of things, all right? So now let's get into exactly what he is looking for, all right? He's generally looking for companies that have a market cap bigger than $10 billion, all right? A market cap bigger than $10 billion. What a market cap is basically, it's what the company's total value is, okay? And how you can calculate market cap is you can take however many shares that company has outstanding and times that out by whatever the share price is, and you're gonna get what that market cap is, all right? This is a company's valuation. He generally sticks to companies that only have a market cap over 10 billion, okay? We'll just say, we'll say here 10 billion plus, okay? 10 billion plus. It's very rare I ever see Warren Buffett invest in a company that has a market cap under $10 billion. Like, it almost doesn't happen. A few reasons. One, this helps mitigate risk. You're investing in companies that have market cap over $10 billion. These are bigger, very well-established companies, generally speaking. And the chances you're gonna, I guess you say, lose a massive amount of money, it's a little more slim than if you're investing in companies that maybe have market caps in the hundreds of millions, or maybe $1 billion, $2 billion, $3 billion market caps, generally speaking. So it's generally speaking a little safer to invest in bigger type companies, all right? Also, he doesn't really invest in too many smaller companies because he has so much money to invest when he's looking to buy a stock. And so to get a nice ownership position, he needs to invest in companies that have $10 billion plus market caps on them, all right? So that's a big thing. He also is looking for generally companies that pay dividends, okay? He loves dividends, okay? Dividends are his thing. He will mostly invest in stocks that pay dividends. If it doesn't pay a dividend, he's not very interested in that particular stock, all right? Here's why. Dividends also give another form of protection to the stock, okay? So when you buy a stock, there are two ways to make money. One is those shares go up over time. The other is you get paid out money in the form of dividends, all right? Whether we're talking about special dividends or just regular quarterly dividends, which most big companies pay every 3 months. So it gives you a lot of protection when you buy companies that pay out dividends, right? Remember I told you just a minute ago, and you know, his IBM stake, I think that was one of the very few mistakes in recent times he lost money on. I know Tesco was another one. Those are the two only investments I can think of that kind of went bad for him. On the IBM stake, I think he actually technically still made a good sum of money on that stake just because the company paid him out a lot of dividends while he held those shares. Now, if he invested the money in some of his other companies, we could say he could have made a lot more, yes. But I don't think he technically, we could look it up, I technically don't think he lost money in IBM because he made so much in dividends, okay? Which is incredible to think about. This gives you some protection, something to think about there, guys. So he's sticking to companies that are bigger. He's sticking more to companies that pay a dividend, all right? He's also looking for companies that have a big competitive moat around them, okay? Now, there's a lot of talk recently about competitive moat. Elon Musk says there's no such thing as a competitive moat. Warren Buffett's a huge believer of competitive moat. What a competitive moat, well, what it basically means, okay, is imagine you live in this castle, okay? You live in this castle, it's in between a piece of land, all right? And you live on this piece of land and there's a castle there and it's like people could come invade you from all over the place, right? People can come and imagine it's like the Middle Ages or whatever. People would come and invade you. Well, if you got a nice, you know, big walls around your castle and whatnot, and you got water with alligators in between it, and you got bridges that come up so no one can get over unless they actually go in the water. They build their own bridge trying to get into your castle. That's a big competitive moat, right? That's a moat around your castle. It's the same strategy when you're thinking about picking a stock, right? You want a company that can fend off companies coming against them, because we know we're talking about companies that have many billion-dollar valuations on them, okay? 10 billion, $100 billion valuations. When you are making that kind of money, you got those type of valuations, like there's gonna be a lot of people coming for you. There's gonna be a lot of people gunning for you, right? There's a lot of people trying to come in that castle and get your money. So what you need is a strong competitive moat around that business, all right? So competitive moat, we could break that off in a few different things. We could say brand, reputation, brand rep, which basically, think about it a few different ways. Brand reputation. If you're a consumer brand, how strong is that consumer brand? You got to think about some of the companies Warren Buffett owns. Coca-Cola, it's about as strong as that's the first investment I think about. It's one of his biggest investments because Coca-Cola, right? Does it get any stronger of a brand reputation than Coca-Cola? And then you think about all the massive amount of brands Coca-Cola owns that people drink on an everyday basis, okay? They have an unbelievable brand reputation. Maybe some of their products aren't the most healthy and whatever, we could talk about that, but in terms of people knowing it and massive amounts of people drinking on an everyday basis, brand reputation is off the charts for something like Coca-Cola. You can also think about it in a business-to-business environment. What is that company's brand reputation with other businesses they do business with, okay? He's looking for companies that have strong brand reputation. That's a big thing for competitive moat, all right? Also, another big thing for competitive moat is balance sheet. This is something people don't even think about. The balance sheet, which once again is the assets versus the liabilities. The balance sheet, here's the thing with the balance sheet, guys. If you got a lot of money in cash, you got a lot of money in investments, you got a lot of assets out there, right? If hard times come, another company might get it way worse than you. Another company might go bankrupt when times get rough because either that industry went south, the economy went south. We know recessions happen, right? Some companies go under because they have weak balance sheets. If you have a great balance sheet, you have another competitive moat around your castle, all right? Because you can get through the bad times. You don't have to fire all your employees or lay off all your employees because you can't afford it. No, you got cash on that balance sheet. You got money, all right? That's a competitive moat advantage. Another thing is profits, okay? Profits, that helps out with the competitive moat in a big way. If you're not making any money in your business, That's a vulnerability. That's a huge vulnerability if you're not making any money, because that means you're losing money, which means your economic impact is less and less and less every single day, every single month, every single quarter if your business is consistently losing money, right? Think about it in this way. Let's think about, let's say you got $10 billion in cash on their balance sheet. You know, let's think about this for a second. You got $10 billion of cash. Well, if you're losing, let's say, $1 billion every year, you're taking a $1 billion loss every year. Next thing you know, you have $9 billion. You know, you take another $1 billion loss. Next thing you know, you have $8 billion. Next thing you know, you're going to eventually have no money left in your balance sheet, or you're going to have to take out loans, then start paying interest on debt. All right. And it's just your competitive moat's getting less and less and less. You're loaded up on money and you got big profits coming in, then guess what ends up happening? Your competitive moat widens because you're $10 billion, you make an extra $1 billion in profit, you also have an $11 billion profit. All right. It's a vulnerability if you don't have profits. All right. This is what we're talking about with competitive moat. And one last thing with competitive moat is we'll talk about management. Okay. Management, a great management team knows how to fight off the competitors. A great management team knows how to fight off competitors. So you always want to look and see like what are the management teams out there? Like what gives this management team a competitive advantage over this one over here? Like what has this management team done in the past that's going to give me confidence that they can execute on this plan in the future? It's a big thing to think about there, guys. So that's what we're talking about with competitive moat. These are the type of things he's really looking for, all right? He wants big profits. He wants a great balance sheet. He wants a great management team. He wants great brand reputation. He wants dividends. He wants market cap over 10 billion, all right? This is what we're talking about, okay? Now, here's some, probably some of the biggest stuff I'm going to share with you now at this point, okay? We're going to get into some of the most important stuff you could possibly talk about, all right? So there are a few ways you can think about investing in stocks. You can think about it from the perspective of, I want to go and I want to buy stocks just because I like that stock, or, you know, I think that stock's going to go up. Let's just put it that way. You can think about it that way. I think that stock's going to go up, so I want to buy this stock, okay? It's not really how Warren Buffett thinks about buying stocks, okay? How Warren Buffett thinks about buying stocks is he says, I got a lot of money all the time, man. I got a lot of money all the time. Here's what I'm going to do. I'm going to wait for values, okay? When I feel like there's a good value out there, I'm going to go ahead and buy those shares, okay? I'm going to go ahead and buy those shares when I feel there's a good value out there. Not when I'm desperate to buy shares, okay? Warren Buffett will stack money on that balance sheet of Berkshire Hathaway, okay? He's never in a position where he's desperate to, I got to go buy a company right now. He waits for his opportunities because he's got so much money pouring in that he knows, man, that money's just going to keep piling up. That money's just going to keep piling up, and I'm going to see a value, which values always come because either something happened in the stock market short term, everybody got freaked out, stock market went down. He sees a bunch of values out there and he goes and buys those values, okay? That type of stuff always happens. Every now and then, the stock market will actually legitimately crash, which is very, very few and far between. Crash meaning 20+% downward move. Those type of opportunities, you got a lot of cash, you're ready to go, you're gonna get a massive amount of values and a massive amount of stocks, right? It's pretty much like you can't miss. When the stock market crashes and you start investing, it's almost like you can't miss, man. And like it's hard to, you know, not make money in the stock market going long on shares after stock crashes happen or something like that. This is what he's trying to do. He's saying, I got money all the time. I got money pouring in from all my stocks, which he owns a massive list of companies. We're talking about some of the biggest companies in the world, some of the biggest banks in the world, some of the most profitable businesses in the entire world. He's got them paying out him dividends. He owns 100% ownership of a massive amount of companies. He's got all this money coming in. He's not desperate, okay? He's not the D word, all right? You got to think about this. You never want to have the D word going on. You never want to be desperate to buy shares, all right? And there's so many stocks out there. There are thousands of stocks to pick from, okay? Thousands of stocks, okay? Thousands of stocks that you could invest in, all right? Never be desperate to buy one, okay? Never be desperate to buy one because there's so many opportunities out there. There's so many opportunities out there. Like, why get desperate to buy one stock when there's so many fish in the ocean? There's so many fish in the ocean. Like, why get desperate? He never treats it like he's desperate to buy shares, okay? It's another big thing. Apple has been a phenomenal position for him. You know, I don't know what their cost basis is on Apple. But based upon where they started buying it and the kind of like where they've been buying it at and whatnot, I would say their overall cost basis in Apple is probably somewhere around 125 right now. They started buying it way cheaper than 125, but they've also bought a lot of shares above 125 now at this point. That's a great value he got on Apple, okay? And he waited on Apple until he fully understood the business and it was in his circle of competence. He realized the competitive moat this business has. And then also, you know, what did Apple start doing? They started paying out dividends, okay? And he says, wow, this company has a great competitive moat around it. They pay out all this dividend money. I'm going to get to build bigger and bigger stake in other companies. In this company, through all those dividends, this company is going to pay us out over the next 5-10 years. The guy's kind of older up there in age and whatnot, right? But he still thinks in a long-term mindset. And he's thinking, you know, imagine the type of dividends Apple's going to be able to pay out 5 years from now, 10 years from now, 15 years from now. It's going to be pretty amazing how much they're going to be able to increase that over time, okay? So this is how he's really thinking. He's thinking, man, I want a good value. Then I'll go buy, okay? I'll save up money until I'm ready to go buy, okay? And that's a big thing. Like, never be desperate to buy shares. Buy shares when you feel the company is a good value. And that's it. If you feel the company is overvalued, don't necessarily buy it. But on the same token, he says sometimes it's better to pay a fair value. He says sometimes it's better to pay a fair value for a company than pay an undervalued valuation for a poor company. Very important there. It's sometimes better to pay a fair valuation, what you feel is a fair value, rather than pay an undervalued valuation for a poor company or in a company that's just okay, okay? Creme de la creme company, a company that has a great management team, a great brand, a great competitive moat. That type of company, sometimes you got to pay a little bit more of a premium for those type of companies, but sometimes it is very much worth it rather than finding the stock over here that it looks like it's very undervalued, but they don't have a very good management team. They don't have a very good competitive moat. You know, it's just a lesser of a company. Sometimes it's better to pay the creme de la creme, the top brand, okay? Buy the top brand in that industry rather than, you know, reach down and buy something that's at a lesser. And this is something big, guys. Like buy the top brand in a lot of industries. If you want to buy a brand that, you know, is like the third tier brand there, fourth tier brand, and there's no real promise of them ever becoming the top dog, sometimes it's better just buy the top brand and you're going to feel a lot more comfortable about that investment. Okay, that's a big thing I try to do whenever I'm like looking at any type of industry. I'm trying to buy like the creme de la creme of that particular industry. I think it's a really big thing rather than try to say, well, there's this number 3 player in the industry. Their stock's a little bit cheaper on a valuation basis than this other company. Maybe I'll buy the third tier there. No, you really want to stick with the top dogs in their industry. Whatever they compete in, you really want to pick the top ones, okay? That's a very, very big thing. And what he'll do is he'll build out a massive portfolio, okay? And let's talk about how he builds out his portfolio now at this point in time, okay? Because he doesn't just you know, load up on one industry or something like that. He doesn't just, you know, see one industry there and just, oh, let me just load up, let me put all my marbles in this one basket here. No. We'll call it the Warren Buffett portfolio, okay? Warren Buffett portfolio. So it's here in the middle. So what he'll do is he'll buy a ton of different, you know, companies from different industries. So, you know, we can think about Coca-Cola. We can call that, you know, I guess a drink company. We'll just call it a drink company. Then he owns a massive amount of shares in Bank of America, Wells Fargo, some of the bigger banks out there, Goldman Sachs. So he owns a ton of banking names. So he owns a drink company. He owns a bank company. Apple is now around their biggest position in Berkshire Hathaway now at this point, okay? So he owns an electronics company, right? We could call it, I mean, Apple's almost more of a, I would almost call Apple more of a consumer products company. They're almost more in tune to being like a Kimberly-Clark or a Procter & Gamble or Johnson & Johnson or something. Like almost like a business that's so reoccurring now that services is in and whatnot, and people just, you know, then their iPhone breaks, they go buy another iPhone. Their iPad breaks, they go buy another iPad. Their Mac breaks, they go buy another Mac. It's almost like a needs-based business now rather than, you know, a one-off type business like we think about with most electronics companies. So he adds that there, okay? Then he goes and adds some business to business, okay? We'll say some B2B type companies, some companies that, you know, do business with other businesses. He'll add some retail names here and there, although he's not nearly as big on retail nowadays as he used to be back before, you know, Amazon started to take over the world and whatnot. Then he'll say, I want to own an energy name, okay? I want to own an energy name of some kind. So he owns a ton of different energy companies, you know, some of the biggest in the world. He owns part ownership of many of those, okay? He'll say, I want to own in airlines. Airlines aren't going out of business anytime soon. I want to own airlines. I want to own credit agencies. He'll just go industry by industry, and as long as it's an industry he understands, he's going to buy shares in it, guys. It's a beautiful thing. And this is literally how Warren Buffett invests, exactly what he looks for in stocks and whatnot, exactly what he doesn't like in a company or in investments in general. I hope you guys really learned a lot from this video here today. Let me know if you enjoyed. Hit that thumbs up button if you got a lot of value out of this. I hope you guys really did. By the way, make sure you follow me on Instagram if you have not already. Like I said, I post a ton of content on there. Especially on the Instagram stories. I'm on there all the time. Thank you for watching. Have a great day.